Hello everybody, welcome to my channel. Today we will be looking at a microcap evolving into the 5G industry. It's called Radcom, the ticker is RDCM, and this presentation is following the Q4 2019 earning reports. And all the metrics and the values that I will share with you are based on the current share price of $6.7. Let's dive in. Presentation will be split into 4 parts. First, I will speak about the 3 statements: income statements, balance sheet, and cash flow statement. And from them, I will extract the main metrics and values to, let's say, develop a DNA card, what I call it, which will help you to decide whether you want to invest in such company or not. Before I dive in, I just want to present you quickly what is this business for Radcom. So the market cap is $90 million, less than 300 employees, and this is a SaaS company, software as a service company, oriented into 5G network assurance solutions. So what is assurance solutions? The main challenge from going from a 4G to a 5G network is split, let's say, in two points. First, there will be much more traffic, much more data exchanged. So it will be a much bigger network to monitor. And the second one is that the reliability will be more, let's say, important. Reason why is that you will have to do some more critical operation on the 5G, probably because you will have maybe a surgery, online surgery. You will have to, I would say, drive a drone, or maybe do some driverless cars operations. So that's why your 5G networks needs to be super reliable. And for these 2 reasons, you need a better way to monitor this network, and this is where Radcom comes into play. They will provide, let's say, solution software to be able to put some, let's say, monitoring on this whatever they call telco cloud and network to help the operator to identify any issue, any error, or anything that has to be resolved, but quickly, and also in an automated way. So that's basically the main summary of the business. These two extract that I took from the presentations from the last conference call. Let's dive in quickly into the technicals. So as you can see, it's been a roller coaster from 2015 and now back to almost square one for after just the crisis that happened for the virus. So we're in a downward channel, but the value at the moment is in the middle of the channel, so it might be a good point, let's say, to enter. We might need to wait for a bit longer, but basically I will explain you the reason why, based on the value, because of the valuation, it might not go solo. Okay, so now let's dive into the income statements. I present here you the 4 last quarters of 2019 values for the margin, revenue, and OPEX split. As you can see, on the gross margin, it's quite stable, going from 65 to 75, but overall a 70% healthy gross margin. The revenue have been also increasing over the last 4 quarters, and the company is expecting for 2020 a total revenue of $35 to $38 million, which correspond to a 10 to 20% yearly increase. So, growing company. Also, on the OPEX split, what is interesting to see is, first, the company, as you can see, is not profitable yet. The net income is negative, but what is super important to see is that they invest a lot into research and development. A company usually invests between 5 and, let's say, 15%, let's say a usual company, technology company. Here, Radcom is investing more than 50%. It's a huge bet for investment for the future to make their, let's say, technology even better than it is today. I gave you here an extract from the last 10K, which is basically justifying the reason why they invest so much into research and development is because they signed 2 multi-year contracts with 2 big tier 1. The first one is AT&T in US, and the second one is Rakuten in Japan. So this gives them a bit more confidence. These are multi-year engagement contracts, So they give them more confidence into thinking, okay, our product is good, let's make it better, and we know anyway that we have more visibility for the future. The second reason why the company is investing so much into R&D lies into this balance sheet. As you can see here, the long-term liability is quite low compared to the cash equivalent and short-term investments. So basically, the company has a huge liquidity. Also, as you can see here, the receivables have been decreasing from 20 some million to 11 million, meaning that the company is cashing in the money in the pocket. In total, the current assets are 83 million, and if you subtract the current liability, it will give you 70 million. This is what we call the working capital. So imagine for a $90 million company having $70 million working capital. It gives them like a lot of room to be able, for example, to invest into research and development. Okay. So that's why it's deserving a very nice smiley. All right, for the cash flow statement, this is a bit of a roller coaster for the last 4 years. It's never up, never down. Operating cash flow is up, one year is down, another is up. Same for financing. But basically, for the operating cash flow is going up sometimes just due to change in working capital, and going down also for negative changes in working capital. Basically, the company is not making enough net income to have like a decent operating cash flow, strong operating cash flow. What you can see here also in red is the financing part of the cash flow has been very high, like over $56 million cashed in via the financing. And basically, this is what you can see here in the table, extracted from the last 10K, is that they issued a lot of stock. So they diluted the numbers of shares. But over 2018 and 19, they haven't done this. Reason why is that probably they have enough cash. $70 million is way sufficient to, let's say, survive for probably 10 more years or 5 more years. So it's a good point for the investor just to know that, okay, the company is not missing any cash and we not have to dilute the numbers of shares. The last part is the investing section. So you can see here they lose minus 40, they get plus 40, and then now minus 63, which is quite huge. But actually, as you can see here from the 10K extract, this is just a play like to, let's say, move their cash into short-term bank deposits. So when they put it, actually, they will declare a loss. And then when they get it back after, let's say, a year of investment, it comes back in, okay? And for 2019, basically, they put this 63 million, let's say, cash that they were available directly into this short-term bank deposit. So next year, it's going to be back to plus 63. So as I was mentioning, the shares outstanding have been really increasing about 2017 mainly, and stabilized about 2018 and 19. But overall, the share dilution was 20%, which is bad, but not so bad compared for such a, let's say, a growing company. Now, based on these three statements, I like to make like this summary card. That's what I call a DNA card. Super important. What I was mentioning is the working capital of 70 million. This allows me to calculate the enterprise value. And look, market cap actually is 93, where you remove the working capital because it's like if cash is not needed into this valuation, so you remove it. But you add the long-term debt, which is $10 million. And you end up with an enterprise value 3 times less than the market cap. And this is just something very, very unique. The earnings, then I need to calculate my free cash flow. So what I do is usually I have the earnings minus depreciation. But actually here in the income statement, the depreciation is included into their OPEX. So basically the free cash flow is equal to the earning. And if you divide the free cash flow by the enterprise value, this is what is going to give you this, let's say, yield return of the company. And at the moment, the company is really negative, is giving you minus 20% return. So based on this value, I do the same calculation based on the last quarter. It gives me also a minus 13%. Based on this value, you would say, it's not so good, not such a good company. That's why actually I make another calculation. Is like if I remove all this R&D, research and development investment, how much the company would yield. So basically, I just take this minus 4.4, and I added the research and development, which was like something like 15 million, yeah, a bit more. And you ended up with like a crazy return of plus 43%. So we can be a bit lost, like, okay, what can we expect from this company? So let's continue into the valuation, and then after I give you my final thoughts on that. On the valuation side, price to sale actually is just less than 3, which is already good for such a company. A SaaS company usually have a EV to sales around, let's say 7 to 10. But here, look, because the enterprise value is so low, you transform your price to sale into EV to sales from 3 down to 1.0. And to me, this is just, it deserves like a very nice green sticker, because it means that the company based on this valuation is really undervalued. Next point, I want to look at the growth for the last 3 years. Company has not been growing so much, okay, only 12% revenue, but be aware that it is preparing, it's like the phase 0 of the big plan, the big picture, because they are already preparing the networks for 5G. 5G will only come in 2020, 2021 and deploy over the next years. So this is normal not to have like such a revenue increase, but at least they entered into multi-year contracts, agreements, and this is already a good sign of the future growth. But basically, when I look only into these numbers, only 12% revenue growth and a 69% OPEX growth, I would not say it's a good company, but has to be put in perspective. Okay. So let's go to the conclusion, because it's super important how to evaluate this company. First, what I really like is to have a super strong balance sheet. Okay, they have $70 million in cash. They have a very low current valuation, but what I told you is like the yield return at the moment is negative. The reason why I will explain you maybe on the next step. The next one is multi-year contracts agreed in 2019 and early 2021. First one is with AT&T. They are proceeding to the virtualization of their network. So they had a 4G network that they want to virtualize. That's the first one. The second one, signed in May 2019, was the new multi-year contract with Rakuten. This one is a brand new network, 5G network, that will be like the first, I think, FVN, a fully virtualized network in the world. And it will be commercialization will start in April 2020. So it's today. The third contract that has been very recent is one with Vimpelcom, which is a Russian operator having 50 million customers. And same, they start this having Radcom helping them to deploy their 5G network. So also, what is interesting to see is, because Radcom hasn't proven their, let's say, the efficiency and this business model to the whole world, maybe in the coming year, when you will see, let's say, that Rakuten or ITAT have been successful, it will give new, let's say, visibility for the other customers, maybe to invest into such a solution provided by Radcom. So it will be like even more visibility in the next quarters. Also, what I was mentioning, like the point I wanted to make directly, is the massive cash available. If you look into the current loss that the company are doing is only $4 million per year, $4 to $5 million per year. So it means that they can still burn cash. For the next 10 years, they will still have enough cash in hand. And that's the reason why I think Radcom is making a good strategy, is that they have enough cash, and instead of making acquisition, they are investing into organic growth. And this is research and development. If they make a better product tomorrow compared to today, they will have more revenue, more contracts signed, and this is a huge investment into the future. So I really like this concept of, okay, the company is not profitable yet, but don't worry, it's going to be very, very profitable in the future. Also, what Radcom was mentioning is that this total market opportunity for automated service assurance is $2.7 billion. So imagine they only make $30 million revenue, which is maybe 1%. So imagine if just they capture 5% of the total market, that could just multiply by 5 the total revenue. Also, they will try to look at revenue increase, recurring revenue, so to secure that, and these multi-year contracts actually are a part of this, let's say, model. The guidance, as I was mentioning, for 2020 was 35 to 38 million compared to 33 million in 2019, so which gives you like probably a 10 to 20% revenue increase, which is still good. And also another point which is not usually mentioned into the stock analysis is the net operating losses of 33 million. So basically, I forgot to put the sticker for the super strong balance sheet, but here it is. I took here an extract from the 10K, and basically this is to explain that the money that they lost over the last years will help them to avoid to pay taxes on the future positive income. And this is what you can clearly see here on the 10K. They say we do not expect to pay tax in Israel on our income from operation until we utilize our carry forward taxes loss. So this means that the next years, whenever you're gonna have a profitable company, all the net income, let's say the operating income, will not be taxed. So it means more money in the pocket for the company. The last points I want to mention about the, let's say, the drawbacks of the situation here is, okay, the customer concentration. They don't have 20 customers. They only have 3 at the moment. So it is still a risk that if one ends up for any reason, which might not be a case, but it might really decrease the revenue. This is a risk. Also, the 5G rollout, because of this crisis, depression might be delayed, which might translate into a revenue slowdown over the next year or two. This is possible. They're also mentioning that 10K that the travel restriction will delay also these contracts, and also because they're usually hunting for tier 1 operators. It's a long-term discussion to get this. They call that a long-term cycle to sign contracts. So if in addition of that they have travel restriction, it can be a bit of headwind. And the last point is that the company remains a small size company. So when this company is investing only whatever $15 million per year, it's possible that a big company decides to put much more money and then become a competitor over the next years. So basically that's it on the conclusion. Let me know if you have any comments. I put back here the DNA card so that you have like a final view on the metrics. But if you have any comments or remarks regarding my analysis, just let me know in the comments. If you have any ideas also for the next videos, just let me know and I will try to do my homework and maybe present you one of these videos. Okay, I hope you enjoyed, and then see you on the next video. Bye bye.